facing people, expats that are living and working abroad. So listen now. You can either listen on our Twitter space, or you can join us live on YouTube, or watch again. Leave us a comment as you go along. We can answer those questions towards the end. But as usual, we'll start this week's live webinar with an update on current news. We've been talking recently about the China crisis, and now it's spread to the garden. There is a big collapse in the share price and the holdings of Evergrande that we talked about last week and in recent weeks, which has led to, in China, there's massive ghost cities of apartment blocks built, which have just not been sold and not occupied. And now, as a second Chinese company, Country Garden, has almost collapsed, just staved it off. They reported a 52 billion loss in the first 6 months of 2023. This has created this big crisis. They had a bond repayment, which was due in September for $22 million that they couldn't meet. And if they hadn't met that would have meant the collapse of that Country Garden. Now, those bonds have been extended. That's given them a bit more time to make that money back up. It stopped them collapsing today. It's helped the recovery of the prices in the very short term of some of the other companies in Evergrande and what have you. But it's still got this China crisis, where they've effectively got this this property in China that they can't sell, and the restrictions on that. And it could lead to a property crisis around the world, or banking crisis around the world, with this amount of debt that could be lost to the international community. So ghost cities in China, bad debt spread around the world. In the unstable world of 2023, we need China to engage with the rest of the world to avoid those debt defaults on their international liabilities and holdings, and the ramifications elsewhere. We're already in a bit of a recession in China, and that could help bring down prices around the world. So let's see how things develop in the coming months. You can keep in touch here at proactpartnership.com. And on our Living and Working Abroad show on YouTube, or follow us on our Twitter space. The next feature we want to cover this week is property rental regulation. Now, for expats, many expats around the world own property abroad or back home and rent it out. And it can be quite a good way of supporting income and lifestyle. Whether your investment is in cash, is in property and businesses, or property, there's always a way to generate an income. And with property, that's the property rental income. Many people have invested in overseas property to get that. But over the last few years, regulation is coming in, and exchange of information has come in. In the past, we've mentioned that the OECD, based in Paris, is increasing its regulations, and they will come up to another level again next year. And this is why banks are increasingly asking you to verify where you live and who you are and what your ID is. That verification questions, that ID questions, are now spreading to the property rental sector. And so you've got issues like in the EU, in Spain, in Cyprus, if you want to rent property as a holiday let using Airbnb, you may need a license to do that. Or you might be barred from doing it altogether in the case if you're not a Spanish citizen. You also have to consider other regulations. Do you need personal liability insurance for your business venture? So the small property exemptions that may have existed in the past are being removed. And from a health and safety perspective, if you've got swimming pools overseas, you could need to have lifeguards or other restrictions on that. In the UK, if you've got a property rental that you're using as a holiday let, you now have to consider the new regulations where you have fire doors and smoke alarms as well. So even though it's a small business, it's an investment income, the costs of maintaining that property rental business are going up and increasing the cost and the management of that. For more help and guidance on your liabilities and the licensing requirements to enable you to successfully run a property rental business and declare those taxes and incomes in the country in which your property is owned and rented, contact us at proactpartnership.com. There's a frozen pond of pension tax traps that's been set under the radar by the UK. In the UK, there was a limit to the amount anybody could put into a pension, and this has been removed so that people can keep working longer, put more money into pensions, getting tax deductibility. When you put money into a pension in the UK, it's into a fund that you get the money out as a taxable income, even when you're living and working abroad. So if an expat with a UK pension fund comes to live in Cyprus, they could pay just 5% tax on that income, as opposed to up to 45% in the UK. So there's a good tax break for expats to take their pension fund abroad. But what everybody with a pension fund in the UK enjoys is a tax-free lump sum. And 25% of the capital of the fund is a tax-free sum. But now that the limit has been raised on the amount that you can put into your pension, on the one hand, the tax-free lump sum is no longer 25% indefinitely. So the pension fund limit was £1 million, just over £1 million. That's been removed, but the 25% of that cap has been maintained. So the maximum tax-free lump sum you can get from a UK pension fund is 268,000, and that's frozen now. That's frozen going forward. So that's not going to go up. So in the next 5, 10, 15 years, that's going to be depreciating as a value. So what can expats do with that? If you're an expat living and working abroad and you've got a UK pension fund, you can consider reorganising your pension fund to take it away from direct UK taxation. Now, there is some restrictions on that, and the UK are tightening up on that so that they don't lose their preferred future taxable income. But you could move that away and reduce your tax liability and your flexibility to draw income, pay less tax, and get bigger tax-free lump sums in the future. Expats that are living and working abroad, you don't have to maintain and top up a pension in the UK. So a UK expat living and working abroad can indeed pay into a UK pension and still get some tax relief and tax credits on the money going into that pension scheme. And that might be deemed to be a good thing. However, on the other side, an expat can pay into a pension fund, and that pension fund can be completely tax-free, even when you return to the UK. So by setting up a pension fund tax efficiently, you can protect your future earnings as a pensioner, whether you're living as an expat abroad or whether you're moving back to the UK. More information and guidance on managing your pension savings while living and working abroad, either once you've moved abroad as an expat or whether you continue to work, contact us at proactpartnership.com. There's a bit of a Swiss cheese conundrum coming up. For a long time, Swiss has been renowned for discreet tax banking and that you could hold an account without people knowing the detail. And things are changing. As we said before many times, international regulation is changing, and more and more organisations are falling under the scope of anti-money laundering legislation. So what the international governments want to do is stop tax crime, terrorist crime, and drug crime, and with that money laundering going abroad. But those rules affect everybody and include not paying tax in the appropriate way. So this is something to think about when you're living and working abroad. Going forward now, the Swiss have introduced regulation so that the banks need to keep a register of the beneficial owners of their bank accounts. But these regulations have been extended to not just banks, but to lawyers, tax accountants, and property rental agents around the world. And as each country applies the new sets of international tax regulations and minimum tax levels, it's going to impact quite radically on what you do. So you can have a discrete tax plan, and you can have a plan that's worked for many years, but going forward, that disclosure of who the beneficial owners are of the business, of the family trust, of the investment holding, by declaring that to a Swiss bank, it puts a hole through any previous discrete tax planning where the beneficial owners are not known. So the beneficial owners will be known, and when the beneficial owners are known, exchange of information between tax authorities allows investigations to take place to ensure that the rules are followed and the right amount of tax is paid for expats and cross-border business, whether that's property rental, contractors, or just people working remotely. For more information and guidance on how to protect your family, business and property, contact us at proactpartnership.com. So that's the news for this week. Thanks a lot for listening. We're now going to go on to our main feature, where we're going to feature inheritance tax. Inheritance tax is a big issue if you have to pay it. In different countries, it's paid in different ways. So in some Scandinavian countries, the inheritance tax is paid by the family receiving it. But normally, an inheritance tax is a form of capital gains tax that's charged on an estate on somebody's death. And it's part of the probate and administration business that occurs. It's based upon your domicile, about where you're from. So if you're a UK born, then a UK citizen, even if he's living and working abroad and dies abroad, has still got this potential liability to inheritance tax on his death, which will charge the estate at 40%. So if you've got property in Britain, property overseas, and maybe some investments and other interests, those are all potentially liable to 40% inheritance tax when you die. We mentioned earlier today about pensions. Money in a pension fund is a pension trust, and that's taxable income when it comes out. That doesn't suffer inheritance tax on death, but there is still a lifetime tax from a UK pension fund when somebody dies, up to 45%. So although it's not inheritance tax as such, income taxes are still going to be charged on that fund. It's another reason why an expat might choose to protect that UK pension trust by having it in a slightly different offshore arrangement. With exchange of information and beneficial owners being known for overseas property investments, companies, and bank accounts, then this also applies to a probate administration. So if you die in a specific country, especially in the EU, you've got an obligation to do your worldwide estate clearance in that country. Now, you may not have an inheritance tax liability, like in Cyprus, there is no inheritance tax. So that tax liability can be paid and is avoided if you're living and die with assets in Cyprus. There's no inheritance tax. However, to do the administration in Cyprus, you have to get worldwide tax clearance. So it comes back to the UK, the exchange of information, the beneficial owners of the company, the trust, or the property are known to the tax authorities, and this information will come through and allow them to charge you an inheritance tax. So how can you avoid that? In the UK, you can make family gifts, and you could. But when you make gifts to family, you lose control. Now, if you're doing it on your deathbed and you're not going to need the money in a week or two, that's not a bad thing. But you can still potentially get the liability to the tax. So some gifts to family can be tax-free now with inheritance tax. Some gifts to family, even in a lifetime gifts, can still attract inheritance tax. There is an inheritance tax, a lifetime inheritance tax charge of 20% if a large gift is made outside of family, for example. So how can we get around this? In the UK, we could use something like a bare trust, but UK trust legislation can avoid income or capital gains taxes, but then has a 10-yearly tax charge as well that potentially puts that under scrutiny. But it can work. For expats living and working abroad, we often get the option of a Cyprus International Trust. The reason being that if you consider a Cyprus International Trust, it's free of all taxes other than anything local that's arising in Cyprus. So if it's earned income or earned capital gain in Cyprus, it will be taxable, but otherwise, Cyprus International Trust is tax-free. So what money would you put in that trust? So there's potentially exempt gifts that you can put into a trust. So like anybody can put a limited amount of money into a trust, and that's potentially exempt. That's limited to 325,000 in any 7-year period. And anybody can benefit from that. So for a married couple, that would be 650,000. So you could get 2 million into the estate over 15 to 20 years. When you die, you've got that £325,000 allowance. But if you use a potentially exempt gift, that includes that 325. If you're married, inheritance tax is not charged to the widow, but it carries on and goes to the estate. So if a couple, one of them dies, there's £325,000 allowance each on first death and second death. So the widow can keep the whole of the estate with the 700,000 until second death, and then distribute to beneficiaries, with only the excess being charged to inheritance tax. If somebody's widowed and remarried, they keep their first partner and their second partner's personal allowance to carry it forward into the future. So it's only when the last person dies that the inheritance tax has to be paid. But that depends on dying at the right time with the right scenario. Whereas if you gift to the family and can retain control, then there's potential tax savings in the long term. When you have a company, and you then go cross-border and you set up a number of different companies, you might need a holding company in each country to manage your different operations. So if Google open a branch in France, they'll have a French business, one in Cyprus, one in the UK. There is Hewlett Packard had a business in Russia, and then they sold that because of the sanctions, and then they moved away from that. So you can have a branch in every country, and that's a very effective way of doing that. And then there's a holding company in the centre that receives all the net profits from each of those trading companies as that progresses. But any company is then always subject to the corporation tax. When you use a trust can be also a form of holding structure for businesses, as well as property and investments. So a family business can have their company, their property, and their investments all held inside the family trust. And as we said before, if you're using a Cyprus International Trust with worldwide assets, there is no tax on those worldwide property or business or investment gains. Now, it doesn't mean that there might not be local trading of a company or local property gains or property rental income. They would still be taxed appropriately. There's no additional charge. There's no corporation tax charge. So corporation tax is 25% in the UK on one extreme, or 12.5% in Cyprus at another extreme. So there's no corporation tax. So once the assets are in the trust, any income or gains that they earn is completely tax-free. But also, within that trust, it becomes free of probate and free of the need for any administration in the event of death. So you've got a holding company arrangement for your family's affairs, for the business, for the property, and for the savings that can survive you, that you can control during your lifetime, and it's free of tax, and it's free of probate and administration. The beneficial owners of the trust will be known, but that's okay. One of the problems with gifting to save inheritance tax is losing control. And if you don't want to lose control, then the trust is a way of the family holding on to a semblance of control. So you could, the trustees and the protector, the chairman of the trustees, control the assets. And what they mean, it can be a direct or an indirect beneficiary depending on how you work it. For example, a couple could have one as a settler and one as a beneficiary. But even so, once a trust is created, you can make loans to people. Instead of having a loan with a bank for a mortgage at their expense, you can create your own banking system and make your own loans. But that can also be a way of providing income as well. So it becomes a very efficient way of managing your assets that on your death or is free of probate administration. When people, as they get older, get dementia and get or go into homes, long-term care arrangements come into place. And again, these are often done through trusts, so they're still able to benefit from their family wealth with the money being held in the trust. And for that reason, it's because they haven't got the capacity to look after themselves. But if you've got time and energy and foresight, you can make your potentially exempt gifts into your trust arrangement and protect it from potential inheritance tax in the very long run. Prite are expat experts. If you go to our website at pritepartnership.com, you can read more on our this week's show, where we detailed the issues around using a trust as a holding company for the family business, be that property rentals, investment holdings and income, or whether it's a contractor and an overseas company operation in multiple countries. Provides a sound way for you to manage your affairs while you're living and working abroad or investing overseas. And you avoid the cost and delay of probate, and your family take over as trustees and manage your wealth down the generations for your children and grandchildren and beyond. So for more information and guidance on that, contact us at approachpartnership.com. Got one question today: is it expensive to run a trust? If you're creating a trust, it is an extra layer. So if you're operating a company, yes, that is expensive. So there is an administration cost and an additional set of tax returns to do for the trust. But the idea is that management cost, it is not the same as the tax cost going ahead. So when you die, you leave your widow and your family with the cost and delay of managing the probate and the administration, especially cross-border, the fees involved in that, and potentially the inheritance taxes. So you have that liability when you die, or when you lose your health. So by making those arrangements now and planning ahead, you're spending that money, that time and expense now to make sure that your family don't have that cost delay when the time comes that your family circumstances move on and we need to change ownership to the next member of the family. So there is a cost, but with the Cyprus International Trust, there isn't a tax cost. So there isn't a corporation tax, but that's 25%, 19%, 12%. No corporation tax, just administration costs. And if the family are involved as trustees, they get control of that. So for more information and guidance, contact us at approachpartnership.com, and we'll see you next time. Thanks very much for listening.